Mhm. Sure. All right. So good morning, everyone. So we are very excited to, have Brett to first present his paper on fair value changes net recognition in net income. So the floor is Brett now.
All right. Thank you, Annika. Let me share. Get back to the beginning here. So first of all, thank you to everyone for being here this morning. Thank you particularly to A Young and to Stephen for organizing this kind of workshop series and for inviting us to present our paper here. This is a paper that is co-authored with Bohan Song and Shen Wang, both also from Tulane University. I was just mentioning to those who were in a little bit earlier that Bohan just successfully defended his dissertation. So kudos to Bohan. We're very excited and proud of him. And Shen is another one of our PhD students here at Tulane. And we've been working on this for a year and a half, maybe. But we're going to be talking about, well, I'll just kind of skip to it, this motivating question of, what are the costs and benefits of recognizing fair value changes in net income? I think this is a good fit for the accounting design project because while we don't necessarily in this paper and can't in this paper make a normative statement about whether recognizing changes in fair values of assets and liabilities and net income is a good or a bad thing. It's certainly a question that comes up a lot. And so, anytime you're thinking about some sort of question of how should we do accounting, one of the first things you need to know are what are the potential costs and benefits of doing so. And so, this is not a new question. It's a question that standard setters and accountants, academics have been asking for quite some time. But what are the costs and benefits of recognizing fair value changes in net income? Let me see if I can move my thing here so that I don't see everybody. Maybe I can move it over here. Okay. And so more specifically in this paper, we look at the research question, does recognizing fair value changes in net income impact firms' investment portfolio choices? And people have different opinions of whether you should preview your results or wait till later, but we're looking at this adoption of ASU 2016-01. That standard required a change from kind of the old FAS 115 world where if you classified an equity security as available for sale, you could recognize changes in the fair values and other comprehensive income. ASU 2016-01 said that for equity securities, at least, there's no longer this available for sale classification, and these things are just mark to market to fair value, and the changes in fair value in these equity securities go through net income. So we use this adoption with kind of a diff and diff design that I'll get into to look at the effect of recognizing these fair value changes in income. Quick preview of what we find is we find that it leads to or is associated with at least a reduction in the riskiness of the equity portfolio. So we show that the adoption is associated with a decrease in equity portfolio volatility, the weighted average beta of treated firms' equity portfolios, and the volatility of their unrealized gains and losses. We're going to do some cross-sectional analyses where we show that those reductions in risk in the equity portfolio are less pronounced when firms outsource a portion of their management of their assets and when the equity portfolios are relatively larger. We look for evidence of potential spillover effects of this. So if we change the level of risk we're taking in one area of the firm, how does that affect risk that we take in other areas of the firm? So far, we haven't found any evidence of spillover effects, but if anybody has suggestions of other things to look at, we would be happy to hear that. And we'll be happy for everybody's thoughts and feedback on this paper as we think of kind of different kind of places to take it. So in terms of motivation, anybody who's logging into this is probably pretty familiar with the fact that the merits of fair value measurement have been debated for a long time. And so what are the dimensions of this debate? And that helps to understand kind of where we're coming from in this paper. One of the very common questions that's been studied a lot is, should assets and liabilities be periodically remeasured at fair value? So this is the historical cost accounting versus fair value accounting debate. Should we remeasure assets and liabilities at fair value? So, and I don't know if, hopefully I'll see hands if they're raised. Hopefully they pop up to the top of the screen so I can see. But if there are any questions, Annika, anybody can feel free to unmute and stop me, or just let me know if you see one that I'm not noticing. So, so the debate has been, should they be periodically remeasured at fair value? And the common questions regarding whether we should measure things at fair value are fair value measurements relevant? So do decision makers, people using this information, care about the fair values of assets and liabilities? And then even if they care, can those things be reliably measured? Another question is, okay, as soon as you start now marking assets and liabilities to fair value on the balance sheet, we've got a double entry accounting system. So now that you're changing the value of an asset or liability, you have to do something. So let's say you increase the value with a debit, you got to put a credit somewhere, right? So where should that credit go? So should the changes in those fair values go through net income, or should they be recorded somewhere outside of income? And this is a tough thing, and the FASB is still kind of wrestling with this idea, because there's been recent talk about how there is no conceptual basis for what is net income versus what is comprehensive income, and how do you carve comprehensive income up into net income versus other things. Proponents of measuring, I'll kind of focus on this third one here, should they be recorded in net income or outside of net income, since that's what we're talking about. Proponents of doing that say that it could provide investors with more relevant and decision useful information. So to have those changes go through net income is going to make net income more decision useful. Opponents would say, some of these changes are maybe transitory. This is what the debate always comes down to. Are they transitory? Are they persistent? What does that do in terms of our ability to predict future income, let's say? So opponents might say it makes net income, and I should have put this word also in quotes because I have excessive in quotes, unnecessarily volatile. So I don't know what necessary volatility is, but an opponent would say it makes it unnecessarily volatile. So net income doesn't reflect long-run performance due to this excessive volatility. Again, what's excessive and what's not excessive, or necessary, unnecessary, that is a matter of debate. Yes, Young.
Yeah, so Barrick, when I read your paper, the first paragraph in the introduction, I kind of feel like you probably don't need to talk about this debate, right? Because your paper is about displacement. Like, where do you want to report this credit or these changes in remeasurement based on fair value? But all your test and hypothesis is not about the comparison between two measurement regime. One is based on fair value, the other one maybe historical cost. Right.
Yes, I agree. So it's this, so it's where my little.
But I feel like what's missing is somehow you need a sizable friction to argue that where do you report this, either in the equity section of the balance sheet or income statement, really make a difference. Somehow investors have limited attention that the second paper talk about, or they only fixated on the earnings bottom line number. They don't really look at other line items or look at the other report to actually somehow has some effect on the firm's real actions, right? I think that is something missing, but it's not a debate about measurement. Yeah.
So I do think this part of the debate is relevant to us. I think that this up here, should they be measured at fair value, that's not what we're looking at, but it is part of the overall kind of fair value accounting debate. But this one is very relevant, And then when I'm talking about the proponents and opponents, I am talking about should these things go through net income or not. Yeah, and I completely agree that one dimension to look at is decision usefulness of earnings, right? But that's not what we look at in this paper. We're more focused on what are the real effects of this and could it affect a firm's actions. And in that sense, it gets a little bit to like what are managers' preferences for the volatility of income and what are their perceptions of how investors will respond. But point well taken that there's different aspects to this that I think are important to study. And some of the other studies on this topic are looking at, like the next one, a little bit more at the kind of the decision usefulness of earnings piece of it. Let's see, how do I get back? There's my mouse. So we think it's important to understand if there are real effects of including fair value changes in net income, not only for this setting, because the question will come up. It's like, well, is your finding in this study, does that generalize or does that have implications for anything else? And I would argue that even though we're looking at a particular setting, and a particular standard, that yes, this has implication for other accounting debates, right? We have AOCI related to derivatives. We have it related to pension liabilities, foreign currency translation adjustments. More recently, I was on this was probably a year ago, I guess, I was on a conference call where they were talking about the adoption of the CECL model, current expected credit loss model. And a banker was saying, oh, now we get these big swings in our provision because of the CECL model. Maybe this whole thing shouldn't go through earnings. Maybe a portion of this should go through OCI. I don't think that's going to happen, but like the question comes up all the time. Just last week, I think I saw an update saying that they're talking about changing the accounting for goodwill. So they're going back to an amortization model. And then they were saying, okay, well, should the amortization go through earnings or should it go through OCI? So this question persistently comes up. So specific to measuring financial assets, that FASB has been trying to make improvements to this accounting for quite some time. So this is just a quick timeline. So 1991, they said, well, you don't have to mark things to market, but we should at least disclose the fair values of assets and liabilities. So required disclosure of fair value financial instruments, but not recognition. They took a step further in 93 when they adopted FAS 115. They say, all right, now we're going to create these 3 levels of securities: trading, available for sale, and held to maturity. If they're trading and available for sale, they have to get mark to market through mark to market. If they're trading, the different changes go through net income. If they're available for sale, they go through AOCI. And equity securities fell in this bucket as well. You could classify them as available for sale. I worked at a bank during the financial crisis, and we had a portfolio of available for sale equity securities. And I remember thinking at the time, this OTTI impairment model makes no sense for these types of securities that have no maturity. In 2008, FAS 157 went into effect, which didn't really change what needed to be fair valued, but it changed the way you were supposed to measure fair value. So it introduced maybe not introduced, but it required the exit price notion for marking securities to market. And then this is when I was working at the bank. We saw these big declines in the value of certain securities and debt securities particularly, and firms said, hey, we don't want to have to recognize these big declines in fair value and net income, and this is having potentially pro-cyclical effects. So the Emerging Issues Task Force came out and said, all right, well, you don't need to put the whole thing through earnings. You only need to put the portion that's related to credit through earnings, and the rest can go through other comprehensive income. And then finally, this is what we're looking at now. ASU 2016-01 requires equity investments to be measured at fair value with changes in fair value recognized in net income. So this is the change that we're looking at in the paper. So formerly, for equity securities, specific to equity securities, you could classify these as trading or available for sale. If they were trading, the changes went through net income. If they were available for sale, it went through OCI. That's gone away for equity securities. So now for equity securities, all these changes have to go through net income. And this was effective for fiscal years starting after December 15th, 2017. prior literature, I won't spend so much time on this, but there has been prior literature looking at whether what are the effects of, this is to A. Young's point, right? What are the effects of historical cost accounting versus fair value accounting? So now if you make a firm record something at fair value, what are the potential effects of that? And they have found evidence that fair values are value relevant. There's mixed evidence regarding whether changes in value are clearly associated with market value changes. And there's some evidence that including fair value changes in income could make net income better reflect firm risk. So for instance, this Hodder Hopkins and Wayland, they look at historical cost net income, partial fair value net income, and then full fair value net income. And they make the argument that the volatility, yes, while fair value volatility, if you use fair value through net income, while it makes net income more volatile, that volatility reflects certain dimensions of firm risk, and in their case, bank risk. More closely related to ours, requiring measurement of assets at fair value can affect firms' investment choices. So again, this is switching from historical cost to fair value can affect the firm's choice of whether to hold or their holdings of certain types of securities. There's two studies in particular I list here that look at the adoption of FAS 115 and said when firms were required to recognize things at fair value, they decreased the riskiness of their investment portfolios, or potentially they manipulated classifications of certain things. But one thing that I want to point out that is unique about our study and is different from any studies that have been done before is, and again, this is to A. Young's point, prior studies have kind of looked at this historical cost versus fair value question. Okay, if you make them recorded at fair value, what impact does that have on their investment decisions? And typically that's been looked at a banking context. And in that banking context, one of the key drivers of their investment decisions is these fair values affect regulatory capital, banks' regulatory capital. In this study, we are looking at a setting where assets are already carried at fair value. So we're not looking at fair value versus historical cost. The only difference is the kind of the geography of those changes. Does it go through net income or does it go through OCI? So I think that's something I really like about this, and it's something that's different than what's been studied before. Another kind of key feature here is, like I said, these prior studies have kind of found evidence that the fact that it can change firms' investment decisions is because it can affect these banks' regulatory capital. In our setting, the adoption of ASU 2016-01 has no effect on the determination of regulatory capital. And because I'll reiterate this in a minute, because insurance companies who we're going to use to study our research question follow statutory accounting principles, and statutory accounting principles did not adopt ASU 2016-01. So there was no change to statutory accounting principles. So we think this is an ideal setting to test the consequences of reporting changes in fair value in net income versus outside of net income. So hypothesis: does recognizing fair value changes in income affect firms' investment decisions? On the one hand, firms might decide to decrease the risk of their equity portfolio to mitigate what they believe is excessive income volatility. Again, this doesn't necessarily rely on, income actually being excessively volatile. It can operate through management's perceptions. And we know from prior studies that managers tend to not like a lot of volatility. They think that increased income volatility can affect investors' perceptions of firm risk. And we know from the Chevrolet survey in 2012, they surveyed a bunch of CFOs. They prefer smoother earnings and want to eliminate the impact of uncontrollable fair value changes on performance. So if you make net income more volatile by pushing fair value changes through net income, we think it could prompt management to take actions to try to mitigate that increase in volatility. So as with a lot of fair value related proposals that the FASB gets, they get a lot of comment letters. And so here are just a few examples of some comment letters that they received. We have one in our paper that's from a life insurance company, but even though we study P&C insurers, and so people say, oh, there's some disconnect, but I think the comments kind of are valid regardless of what type of company we're talking about. And actually, I think it's interesting that they got comment letters from people in several different types of financial services firms, which again speaks to the potential generalizability of our result. But here, the Hartford Financial Services Group said that applying fair value to net income model reflects unnecessary volatility in the income statement and therefore is not decision useful. So they're against it. Allstate, you're in good hands with Allstate, but they don't want this fair value net income thing, because they say given periodic market trends, equity volatility could be as large as 10 to 20% in any given quarter. This might be one of those quarters that we're in right now, and the market is plunging. So what's that going to do to these firms' net income? Stephen.
Yeah, Barrett, this volatility thing, you get more volatility with negative zero correlation. If you've just got a bond with a constant interest rate and you just market to market as it gets close to maturity, there's no volatility. Here we have volatility because one period you may have a gain, the next period you may have a loss, okay? Now, if it's an efficient market, of course, this fair value thing is okay in theory, okay? But we get the situation where, we have investment in technology, let's say, okay, which if you do any fundamental analysis, you have reservation whether it's reasonably priced. And so what you're doing is in fair value accounting, you're putting potentially putting bubble prices in the financial statements. And those are bubble gains that go through to the income statement, which are not, in accounting terms, they're not realized yet. And you see a number of examples of this. Amazon had a huge increase in net income by $11.6 billion in the last quarter of 2001 because of the mark-to-market of Rivian automobile. It actually declined 80% up to this time. So
that was 2021, did you say?
What?
That was in 2021?
In 2021, they marked
Rivian,
a quarter gain of 11 point something billion. And now the stock is down 80%. So I think a more fundamental question is, a related question is whether you're getting actually bubble gains in. So we say these are not just not persistent earnings, they're actually negative correlation earnings, okay? Mm-hmm. If you assume efficient markets, everything's fine. So one thing I might suggest is, why don't you look at stocks which are marked where the PE ratios are really high, or you have some fundamental analysis assessment of the value and look at whether you do see this negative zero correlation, as in the Amazon case, because I think that is potentially the more interesting aspect. Not that you have more volatility, but actually you're building in gains which are going to reverse under rational pricing. And now, on average, I don't think you're going to get it because the market sort of on average is efficient. But if you look at those cases particular cases where there is evidence from a fundamental analysis that the stock's underpriced or overpriced or underpriced, you get this negative zero correlation. And so that makes the earnings not just volatile, but uninformative.
Right.
As an extension to your study. And I think it's actually a more basic question than the volatility question.
Yeah, I mean, I agree. And so you're getting, again, to kind of the decision usefulness aspect of the earnings. And I think that we have security level detail of the equity holdings. So one thing we could do more of, I think, is look at the characteristics of the types of things they're changing their investment in. But I agree with you that that's an important dimension of this debate. I remember when I first got into the PhD program, I think I said to Jim Whalen, I said, well, I think markets are efficient in the long run. And he said, oh, you got to be really careful when you talk about market efficiency, because that's not the way people think about it, right? It's like efficient because it prices it exactly as it should be today. But I tend to share your view, right? Like when when GameStop is running up, you sit there and you say, okay, well, is that the kind of, is that legit, right? Like, and is that the kind of thing, if you were, let's say, a firm that invested in GameStop, we should go ahead and be calling that net income right now? Or do we think that that's really going to come back to earth, be it
Yeah,
in
that's
one
right.
quarter,
I
two
mean-
quarters, whatever the case may be? So what you're saying is you could study the properties of earnings, and you could take advantage of security level detail, I suppose, in this setting to see the types of stocks they own.
Yeah,
Right.
yeah.
And then how cross-sectionally that affects the, say, the persistence of their earnings. You're saying, because you're saying the negative
No, I'm saying
autocorrelation.
that you're looking at volatility, and I think it's just an extension, provided you can get the data of the investment that people have in their investment portfolio. Is this volatility just associated with sort of unbiased volatility as to whether the future is going to be a gain or loss, or whether it's actually correlated? There's a negative zero correlation. We know
Right.
negative
So is
zero
it just kind of
correlation-
noise versus
right.
systematic?
Yeah, there's a systematic. The idea is that one of the objections to bringing this into the income statement is you're bringing mispricing into the income statement. Okay, and that's what a value investor would say. Value investor says, don't you put speculation in the market price into your financial statements. And I think that's sort of basic policy question. I think if you have the data, if you could go that extra step and say, look, on average, it's an unbiased, gains and losses cannot be predicted. Okay, it means zero expectation for the next period. But if you look at certain circumstances, you see this the volatility is explained by the negative zero correlation in the gains and losses.
Yeah. Okay. Yeah. Thank you for that suggestion, Stephen. I appreciate that. Yeah. And I'm not sure, when you get into these insurance companies' portfolios, like how much they're rolling the dice or just trying to, kind of buy and hold.
Can I just jump in for a second?
Sure.
Maybe it's trivial, but I think I would ask myself, why are some of these companies holding enough equity investments that should matter, right? It's a combination of the quantity that I'm actually holding in relative to the level of my earnings. So the argument of the volatility is really a matter of magnitude, right? In general, if I have a lot of magnitude with minimal holdings, then it's uninteresting. And I know empirically we measure it, but if you stop and ask yourself, why should it matter in situations that it does matter? I think the argument that investors should care about and that volatility is quite real is quite acceptable, right? So the point that the comment letters that you brought in that's saying unnecessary volatility, there is no such thing as unnecessary volatility. Either there is volatility or there isn't volatility.
Well, I agree that it's an ill-defined term. Like, how can you say what is unnecessary volatility when you don't know what's necessary, right? So yeah, I think that point is well taken. So I guess I'm trying to understand your comment. You're saying why should this volatility matter to investors, or why should it matter to the firms?
The hypothesis in the comment letters that you're describing, we are having an in principle discussion. And I'm trying to point out the fact that this really becomes an issue in specific cases where we have significant equity holdings that are so significant that the volatility in them is enough to impact the net income. So you have a combination,
material enough to net income.
No,
Sure.
but my point is that we're asking in principle, but there are very specific situations in which this really matters. You need to, in relative terms, have huge equity holdings. You need to have high volatility in them, and you have to have relatively low earnings for this to matter.
Sure.
And what I'm trying to point out that in those specific situations, that is indeed interesting for investors.
The volatility, yeah, the volatility of what they own.
If it's enough, if it's enough, if your income is low enough and your equity holdings are high enough and volatile enough, then yes, this is quite interesting, right? So that's what I'm trying to say, that a theoretical argument of sort of whether it should be or shouldn't be is a little bit divorced of when it really matters.
Right, and we're exploring a setting where arguably it matters the most, right? Because we're talking about insurance companies that have relatively large equity portfolios, certainly compared to a lot of other types of firms. So yes, we are looking at a setting where we think this is most likely to matter. I think in terms of whether it's of interest to investors, again, back to what I pointed out earlier, they've got the information about the changes in fair values regardless. Right. So it's not that they don't have information about the volatility of the portfolio. Now we're just talking about, does it make a difference, at least from managers' perspective, whether this goes through net income or not? And I think that's, to me, that's still like an interesting thing to understand.
I completely agree. I just meant that it's not like the theoretical arguments are, I think, a little bit missing the point that exactly where you're looking at is exactly where it does matter. So the general debate that you sort of introduced was lacking, I think, that actuality or relevance.
I see what you mean. Thank you. Young.
Barrett, I think you have 30 minutes left, and then I do kind of like have questions about how you measure risks.
Okay. So, sure.
If you don't mind, do you mind telling us how do you measure risks?
We will get there now. So long story short, firms pushed back, right? And so the counterpoint to this hypothesis is, I think there's a credible null here, and this gets to kind of what something Benjamin was saying. When these things are really large and important, if investing in equity securities is an important part of my investment strategy, then deviating from that investment strategy could be suboptimal. And so maybe they say all these things and, oh, I don't want it. But at the end of the day, when the rubber meets the road, maybe they don't change anything at all. So I think we've got a credible null, so ultimately empirical question. So I always struggle with making directional predictions when there's two legitimate arguments, like should I just make it a null or should I make it directional? Because half the time I see directional predictions and then they have a throwaway afterwards that says, oh, but maybe won't be true. Anyway, we've got a directional one here because we kind of predict that similar to what some findings in FAS 115 papers, companies will put their money where their mouth is and they're going to reduce the risk. So just quickly, and I'm going to get to the measurement that Young wants to know about. And hopefully I'll be able to answer the questions because Bohan and Sean have done a great job with the measurement of these things. But we're using a difference in differences setup here. So our treatment firms are going to be insurers that either are publicly traded or have publicly traded parents, because we're making an argument that these firms actually do have to, even if it's just at the parent level, adopt ASU 2016-01. And we can compare those treatment firms to control insurance companies that are private or have private parents, and they are still just following statutory accounting principles. So this gets back to the fact that ASU 2016-01 was rejected for statutory accounting principles. So we think this gives us a nice kind of treatment and control group. And we can also, great thing about insurance companies, you can get security level disclosures to measure some things that you can't measure otherwise. So we're going to use this diff and diff setup. We're going to use a pre-period of 2016 and 2017, post-period of 2018 and 2019. So we're going to look at some dependent measures of stock portfolio risk with a pretty standard, we got year, quarter fixed effects and firm fixed effects. So the main effects of treat and post are subsumed. So we're looking at this interaction of treat by post. So, our two primary measures of equity portfolio risk are the weighted average portfolio beta and then the portfolio volatility during the quarter. So Ayon, do you want to ask, are these the ones you had questions about?
Yeah, so I think those are the realized exposed volatilities, right? So I think I try to understand is that your argument is that at the end of 2017, those portfolio managers actually want to alter their portfolio from the higher risk stocks to lower risk stock. There's a little bit of a hindsight bias because they didn't know what's the exposed realized volatility or prices will be, right? You're kind of assuming they almost have a very accurate, perfect foresight. But back then, you probably need to measure risk based on information that is available to them.
Yeah, I see your point.
So similar to Stephen's
so-
earlier point about like PE ratio, all those things has to
Right.
be that available to them at a time when they tilt their portfolio.
almost
not
biases
quarters.
against us finding anything, right?
Yeah.
Because
yeah,
I could try to reduce my volatility, but I could screw up, right? I could,
Yeah.
because I could pick ones thinking they're going to be less volatile, and then it doesn't really pan out that way. So
Or it's not directly testing your hypothesis though. Like you are using what actually happened exposed to argue that they ex ante changed their portfolio. But that information is not available when they change their portfolio.
I agree. I think you can still infer, I think you can still infer that they are, taking some actions. And, the one thing that probably helps is we're in a relatively stable period of time. So and one thing I guess we haven't looked at is for the ones that they hold now, like how much did the volatility, in the post period, how different was the volatility of the securities they bought than it was in the pre-period? Because you're saying they would have been buying based on the volatility in the pre-period, right? Because it's like, well, if I want to buy less volatile stocks, and if I'm deciding today, then how do I make a decision? I probably look historically to see which stocks have been less volatile.
Yeah.
So to the extent that you're in a stable period and the volatility in the post period is similar to the volatility in the pre-period, I think it works out okay. But yeah, we can think about that for sure. Like, is there a way to develop a more kind of ex ante measure? Like at the end of 2017, I guess you could still take the ex post in the pre-period, right? Because that's what it has been.
Yes.
But then like a more ex ante measure of expected volatility.
Yes.
In the post period. So yeah,
So
that's something we can think about.
Related to Steve's earlier point, for example, at the end of 2017, you can actually sort all the stocks based on all the different risk factors, right? Or characteristics, PE ratio, all those document anomaly characteristics, and then to see whether they move from extreme portfolio stocks to kind of more central, right? So that would be that they actually using some sort of screening and then reduce the risks of their portfolio. But you should not use the exposed outcome to judge whether they did it ex ante. Yeah.
Yeah, I mean, I guess you can use the exposed to see if they were successful.
Yes.
Right, but
I think that's not your research question, whether they are good.
Point taken. Point taken.
Yeah.
Stephen, are you clapping or raising your hand?
Well, I'm
I
screwing
claps, I
around.
like
I'm
applause.
screwing around here, but I got a short comment because you got to get on to your results. There's another issue here with respect to this classification, and particularly applies to insurance companies, the cherry picking. The idea before, you could cherry pick realized gains into EPS and leave the unrealized losses in OCI. So that's something that should be in your motivation as attention. Okay, somewhere.
Sure. Yes. All right. So yes, we use these measures of portfolio risk. As A. Young's pointed out, we're measuring actual volatility. So you can argue whether that's the best way to test the research question, but we are looking to see, did the actual volatility or the risk characteristics of the portfolios go down in the post period? We use SPG in my data. Briefly, we first kind of want to look to see, do they dispose of a bunch of equity securities? And we don't find a big change in the acquisition and disposal activity. So I'm going to move on to the test of the hypothesis. Annika. Oh, you're muted. Or were you just telling me I have 5 minutes?
Just to remind that it's 5 minutes left.
Sure, no worries. So here's our main result. Takes till table 4 to get to it, but this is kind of our main result. We find that the portfolio volatility declines in the post period for treatment insurers relative to control insurers. We also find that the portfolio beta declines. So this to us is evidence that they are decreasing the riskiness of their portfolios in the post period in response to having to mark these changes in net income. So, yeah, it looks like they're successful at doing it right now. Was their ex-ante selection what it should have been? Yeah, that's something we got to think about. This was our assessment of parallel trends. You can see the differences, particularly volatility here, not significant in the pre-period, and it declines in the post-period. Alina.
Thanks, Barrett. So hopefully, short question. So do insurance companies hold non-marketable or private equity securities? I thought they did, and I've struggled with understanding the ASU's applicability to those. And it sounds like they're still given that cost looking like alternative to essentially that measurement alternative. So I wasn't clear because I'm not familiar with your data, whether if, for example, given that both are classified as equity, if there's any shuffling in between those, whether you would be picking that up or not.
I need to think about that some more and look to see how significant private equity investments are as a component of overall portfolios for these. We haven't really thought about that, so I appreciate that suggestion. We are merging it with CRISP. So, what we're looking at, the portfolios we're looking at would only be publicly traded equities. So we wouldn't be looking at the volatility of privately traded equities, which again, you're saying those wouldn't necessarily, they might be scoped out of ASU 2016-01 because they are harder to get the market values for. So I do want to look at this. Let's see. Oh, so then we also said, well, did this actually translate into a decrease in the volatility of unrealized gains and losses? So we took, this is one observation per firm in the pre and post period. Did the volatility of their unrealized gains and losses actually go down in the 8 quarters pre and post? And we find that it did. So I kind of liked that test. And I also liked this test. So we did a falsification test to say, well, let's say that these firms had not changed their equity holdings at the end of 2017. Let's assume they held that same portfolio in the post period. Would we find the same decrease in volatility? And we find that you don't find that significant decrease in volatility if they hold that same portfolio during the entire post period. So that we think was an advantage of using the security level data. Cross-sectional analyses, I'm running out of time, but we find essentially some insurance companies outsource a portion of the management of their assets. And so we find that our results are not as strong if managers are outsourcing management of a portion of their assets. So this effect is stronger when the managers themselves are making the decisions about which things to invest in. We also find, and this could be a comfort to a standard setter or somebody who's concerned that, they'll do something that's non-optimal. We find it's not as strong when the firms have larger equity portfolio securities. So as the costs of deviating from their optimal strategy increase, you're less likely to find the results. So they don't do it, when the more significant those portfolios are, the less likely they are to change it. We don't find any results of spillover analyses or effects that I don't have time to talk about right now. But the takeaway is that we find that firms required to recognize fair value changes in equity securities responded by decreasing the riskiness of their equity portfolios. Find that results are weaker when they outsource a portion of their investment management decisions and when those equity portfolios are more material. We think this contributes to the overall fair value accounting debate, particularly should you include these changes in income or outside of net income. I'd be remiss if I didn't discuss there are some concurrent working papers in this space. We're contributing to this emerging literature, one paper of which we are going to hear next. And we're very excited to hear about that, which will deal a little bit more with the decision usefulness of this change. And I'm out of time, so I really appreciate everybody coming and being here, and we appreciate the feedback.
Thank you, Brett. Very nice presentation. So now we have Zechong from Yale. Zechong, you will have 45 minutes, and then I will remind you when you have 5 minutes left. Thank you.
Thank you, Annika. Can everyone see my screen?
Let's see.
Yes, good. Okay.
Mhm.
Okay, first I would like to thank this opportunity to present our paper here. And I really have enjoyed many talks from the accounting design project, and I'm super happy to contribute to this platform. And this paper is one of several concurrent papers exploiting the setting of ASU 2016-01, which studies the impact of incorporating investment gains and losses into net income. So our approach might be a little bit different. So I'm going to first talk about our motivation a little bit. So recently we see that many firms, like non-bank firms, are holding more marketable securities. So they have a lot of cash on their balance sheet, and then they want to invest it somewhere for some yield and for managing liquidity. And then comes the issue that such marketable securities can bring in massive unrealized gains and losses. And the problem is that, well, now we have two streams of income, like the operating income and then the income from investment gains and losses. We probably would agree the former is more permanent, more persistent, and the latter is more transitory, and sometimes it might even reverse itself. So what would be the impact if we combine them into net income, right? And in particular, our approach actually tries to study the channel of investors' inattention. The idea goes as follows, that we all know that if market is efficient, as Stefan just pointed out, if the market is fully efficient, and then this probably wouldn't matter because this fair value gains and losses information was included in disclosure all the time. So, and then we hypothesize that if some investors are unable or do not have time to fully digest the information from disclosure, but they will pay attention to the number in net income once it is realized. And then we think this will bring a huge difference. Okay, and we both study analytically and empirically how this change in net income measurement affects the market pricing and then affect firms' investment behavior, how much they choose to invest in financial assets. Okay, so any questions? Well, I will skip this empirical setting. I think we have already learned about this. So basically, before this rule change, we have equity securities to be measured on balance sheet at fair value. Okay, after this, well, but before this, the unrealized gains and losses will flow through other comprehensive income if it is available for sale security, and it will flow through net income if it is designated as trading. Okay, but after that, we know every, so all unrealized gains and losses will be part of net income. And meanwhile, that securities accounting treatment didn't change. And then later we are going to use the firm's holding of that security as a comparison group to see the impact of this rule change. Okay. So just to elaborate a little bit more, like we think the problem here is to mix two streams of earnings, operating income, and then investment gains and losses. So I think in valuation classes, for example, I was using Stefan's textbook on valuation. So we try to really separate apart operating performance and then the performance from the firm's investment. And so this controversy is if we listen to FASB themselves, they say that they concluded that fair value with changes in the fair value presented in net income is a more relevant measurement attribute for equity investments. They think that information is relevant and can be measured reliably and thus should be part of net income. And many people adamantly oppose this. For example, Buffett was very vocal on this, and he said, well, this standard severely distort net income number and render it mostly useless for analytical purposes. And the point is, like, if the net income number is overwhelmed by unrealized gains and losses from the marketable security portfolio, then it's not very informative about the firm's operating performance anymore. And similarly, Google has the concern that we believe this will divert investors' focus from our core business results. Okay, so we think those concerns are all related to the ability of investors to digest the net income numbers and to digest the numbers in disclosure. So we want to first build a model to really think about this. Okay, suppose the company has two streams of earnings and how the different accounting treatment affect their understanding of the firm's performance. Okay, and then how does that affect the market pricing? And then we will go back one step and say, okay, if the manager really understands the impact on market pricing, how would they choose their investment in financial assets differently? Okay, so here we go. Like, I'll just introduce our model briefly here. So like, first we have 4 stages. The first stage is the accounting regime, whether to include unrealized gains and losses. Okay, that accounting regime is chosen. We study 2 cases, right? The case before and after the inclusion of unrealized gains and losses into net income. And then under each regime, well, the firm's manager will choose how much to invest in their financial assets. Okay, and then according to their chosen accounting regime, then the accounting system will spit out a signal about the performance on 2 fronts, the operating income and then the investment gains and the losses. And then the market trades and the set price. Okay, and finally payoffs are realized. So we can dive deeper into the model. So we assume the firm value is the sum of 2 parts. The first is their operating assets, and then the second part is their financial assets. So here E1 represents operating income, and it comes with a valuation multiple row 1. And E2 is the investment income, right? And in our setting, that would be unrealized gains and losses. And then row 2 would be its valuation multiple. And we assume that accounting provides a noisy signal about both elements. So here X1 will be the measure, the signal about operating income. So that captures the true operating income with some noise eta 1, and we assume eta 1 comes with noise variance sigma 1. And then we also have the signal for the investment gains and losses. And we assume this is measured with some noise 802. Okay. Oh, yes. Yeah, Irene, please.
Yeah. So I have a question. It's more about the wording. So like you earlier talk about Stephen's textbook, and then you kind of
Yeah.
label these two streams of net income as core operation related versus non-operating, right?
Yeah.
But in the model and also exposed when we look at your empirical setting in the insurance company, investment is kind of like something kind of like probably part of their core operations, right? To generate enough cash to pay the pay their policy. So I think, can you think about like they're just two different levels of a persistence that's more transitory, very more persistent. You don't really need to label it as non-operating because empirically you cannot really identify it. And then your setting is actually not a non-financial institution, like the example you gave earlier, right? So that's just a little kind of like minor suggestions on the disconnect between the label and then also the test and then also the model. Yeah.
Yeah, thank you for your suggestion. So yes, so at the core, like in the model, the key difference is in their persistence and their relative importance to the company, right? And yes, we probably should say the difference between a company's operating income and then their another line of investment income is one application of that binary. Yes, yes, yeah, we can do yeah, thank you. Yeah.
Because I think it would be broader, applying to even like both lines are operating income but have a different level of persistence. Potentially your model suggests that US GAAP should actually propose a separation, that reporting those two different streams separately rather than using one single metrics, because it has different implications used for this for investors.
Yeah, exactly. I think that would be that's applicable to Barrett.
Just to make sure I'm thinking about it right here. So X1, it's a measure of, well, the E1, I guess, is a measure of like long-term operating income. Is that kind of the idea? Like kind of your long-term operating income, which may be a little higher, a little lower because your sales or whatever, vary in any given period.
Yeah.
And so then is E2, because this gets a little bit to Stephen's comment to me, is this basically like intrinsic value? Right, but market prices are not efficient, and so I'm just trying to understand in terms of investment gains and losses, or is this like basically your expected return on a security, but it just is higher sometimes, lower others? If you just conceptually help me understand what the E2 is that is then made noisy.
Yeah. I see. I think your point is like in this particular setting, how do we map this E2 right into this fair value remeasurement? Yes, I think it's like my point is like in order to measure my company's performance, then this investment gains and losses using the measurement attribute of market price is noisy. It's probably not. So we can think about this more of as a like true intrinsic value or like the true intrinsic change in my firm's ultimate shareholder wealth. But this change in market price would be one measure of it. And if this A2, the noise term, has sufficiently small noise, so that is if sigma 2 goes to 0, we allow that. And then that's the case where we assume market price is intrinsic value. So our model actually accommodates that as well. Yes, Stephen?
Yeah, just point out, I don't think you need the row 2 on the E2 because a fair value gain or loss is just has a PE 1, okay? Without noise.
Right. Yeah. So either it's 1, if it reverses, sometimes it does, then it might be even less than 1. Yeah. Okay.
Well, that's an inefficient market if it reverses. Yes. Mm-hmm.
Yeah.
That's in your noise, I think.
Right, there is some bit of noise if the interest rate go up today, go down tomorrow. So yeah, there is a little bit of reversal there. Okay, and then now we're going to talk about accounting regimes and how investors process information. So we define two regimes. The first is exclusive regime, under which net income is measured as X1, that is measured only as the more persistent part, or like here we say like the operating income part. Yeah. And then under the inclusive regime, we assume net income will incorporate both parts. Okay, so the more persistent part and the less persistent part. So yeah, again, forgive me for still carry around this operating versus investment gains and losses. It's sort of maybe, yeah, easier for presentation purpose, just to label that. Okay. Okay, and then we assume under both regimes, those numbers are actually disclosed. Okay, but the difference is that there are two groups of investors. There are attentive investors who will diligently read the footnote disclosure and then find those two numbers. And there are another group of investors who are inattentive, okay? And they can be very busy, don't have time to read that, or like they don't have access to those information, or like they do not have the ability to process that information. But nonetheless, those inattentive investors, so the inattentive investors will only pay attention to the net income number. And we assume that here, kappa portion of investors are inattentive. So the remaining 1 minus kappa are attentive. And we assume that investors actually have mean variance preferences. They love return and they hate volatility. And then we also assume the supply of stock is some positive amount. And the market price will be set by those two groups of investors, right? And we want to talk a little bit about how the later market pricing affects the manager's ex-ante decision, how much to invest into those marketable securities. So we assume that the manager aims to maximize the stock price. And what they do is they're going to choose mu2. mu2 is like the expected return on their financial assets. So like the higher the return, we assume the higher the corresponding volatility it's going to carry. So I think this is sort of, maybe we are okay with this assumption, quite general, right? Okay. And how do we really analyze this model? We need to solve it backwards, meaning that we first solve investors' optimal trading security strategy, and so that we can solve for the equilibrium price. And after that, we go back and solve how the manager choose the amount of investment, right? Anticipating the later market pricing rule. Yes, Stefan?
I just wonder whether this is a model that's more general. I mean, one of your problems in analyzing the income statement is there are different types of income which have different price multiples, okay?
Yes.
So the segment reporting is very frustrating because it isn't have enough disclosure to be able to actually assess that. So I wonder whether this is just is a more general model which just applies to when you have different aspects of income which have different pricing multiples. You got different products, you got different divisions and so on. Or is there something specific in here that I've got to see? There's something here specific to this setting of reporting unrealized gains and losses on investment securities?
Yeah, yeah. So I think that's a great question, and that's somewhat related to Ayun's comment before, right? Is that more general? So I think it could be more general. It's actually more about like two groups of earnings, and why we choose to actually look at this ASU 2016 setting. That's because I think that's more the concern from the empirical part of this paper, because we think this is a unique setting and a pretty powerful setting where we see a dramatic change in accounting standards.
Yes. Mhm. Yeah, I see.
So yes, and I think later on we will see one prediction from this model is that because this investment gains and losses can be measured very accurately, and
Yeah.
they are very much not persistent, they
Yeah.
will, under quite general assumptions, led to the problem of firms actually cutting down on such investment.
That-
This
that-
problem would be more,
That's good. You've got a setting here where you get much more concrete into looking to what could happen in a more general situation. So I think that's good.
yeah. Thank you very much. Okay. Now let's look at the analysis. So first, we saw for the investors' demand, it's pretty standard. What we can see is the inattentive investors, they only conditional on the income number, while the attentive investors will condition on two components separately. And we can see, of course, the attentive investors have better information, and then they will have better investment efficiency. If we look at market price, if the inattentive investors are a big group, if they are not negligible, then their valuation will affect market pricing. And in fact, the price will be a weighted average of the two groups' assessment of firm value. And then we need to take out some price discount. There is a price discount because accounting reports cannot fully resolve residual uncertainty. And when risk-averse investors see residual uncertainty, they're going to bid down the price to just to protect themselves. Okay. And then what we can see is first, we can compare how market reacts to the investment gains and the losses. So one quick result is that if we look at the component ERC, so that's the price response to investment gains and losses alone, it would be much bigger under the inclusive regimes than under the exclusive regime. And the reason being now the inattentive investors start to pay more attention because that is part of net income. Yes, Ayun.
So like one thing maybe outside of the scope of the paper, but I'm very curious, is that you have the model and you have the data. Can you tell us what percentage of the inattentive investors is needed for managers to really change their investment decision? Is that 5% of the investors or 50%? Just give a sense of what would be the threshold that when you start seeing
I see.
manager cared about this is actually material to them. And then later on, maybe you can do an estimation on how that magnitude relates to the suboptimal investment level, right?
I see. So that's a great point. I mean, like we would love to look at that. I think I don't have a numerical answer to your question. Like as of this stage, what we did is to look at the analyst coverage, sort of assuming with the helping hands from analysts, investors as a group has more informed, attentive investors, because analysts can actually do away those confusing elements. But we'll think more about that. Yeah, I think it's definitely will make this paper better if we can say more on that regard. Now, the second thing we want to look at is how does this investor inattention affect the price discount, right? And in some prior papers, the price discount is called like cost of capital or like required rate of return. And here we're going to assume we fix the amount of investment in financial assets. Okay, and then we're going to see whether the price discount is higher or lower under the exclusive regime. So, well, actually the answer is not clear. It's not clear which regime would be better at reducing cost of capital. Okay, the reason being that under the exclusive regime, the inattentive investors were at a disadvantage because they just have no information about that unrealized gains and the losses. However, like they don't pay attention, but they know like there is like uncertainty coming out from that investment portfolio. Okay, but under the inclusive regime, what is nice is they know this relevant information, right, about the investment gains and losses. But on the other hand, they are not sure like whether this net income number tells us more about operating income or more about those investment gains and losses. So since the firm value is the sum of two, it's not clear whether the inclusive regime will help the inattentive investors. So what we find is that, well, for first, the price discount will increase in CAPA in the proportion of inattentive investors, okay, because they don't really utilize information very well. They require actually larger price discounts. And then secondly, we find that the price discounts actually can be bigger under inclusive regime. If this condition holds, and it seems like a little bit like messy, but it's quite clear. We can see this inequality would hold if this rho 2 is really small or sigma 2 is really large. And what it means is if rho 2 is small, that means the investment gains and losses are very inconsistent. Okay, so they might just be transitory, or they might even reverse. So if they are not persistent, or if it is measured with large noise, then including them into net income will increase the price discount compared to the case of excluding them. Yes, Ayun?
So one thing related to the model setup is that for inattentive investors during the first regime, you mentioned that they are aware of the firm actually had some investment, they just don't pay attention to. So what if they actually come up with their expectation of the return without paying attention to the company's specific disclosure? They actually can just say, use S&P 500 or market index volatility or expected return and use that as their expected income from the second source, right? That information is easy for them. Oh, so that's something in the model? I didn't pay.
Well, that's not in the model, but actually I think it's not really inattentive investors who will look at the S&P 500 and then pay attention to my company's portfolio and then come up with expectations. So we'll see, like I'll show you a picture later. Yeah,
I think the reason I ask this question is I worry that your results is actually mainly driven by the omission of this extra income stream, but like it's actually quite a strong assumption that they probably are aware of the firm actually having those investments from MD&A discussion. They just don't use firm specific estimate. They can come up with something very rough based on their own trading experience, right?
So I think my take here is like they are sort of aware the firm has those risky portfolio, but they don't really they're not on top of what exactly the company has and how much gains and losses they have this period.
But like, all I'm saying is that I think the benchmark for them is actually they're naive for very easy expected return from that portfolio rather than assuming
Yeah.
there's no portfolio at all.
Mm-hmm.
Yeah.
Mm-hmm. Okay. Yeah. I'll show you a picture later. Yeah. So, well, so now, now we want to talk about the extended investment in financial assets. So now the manager knows how market is going to price, right? And then here we assume the firm's core business is constant. We're not going to change that, but they have the choice of how much risk, right? How much expected return they want to have from financial assets. And then the trade-off is the more expected return you are going to take on, you will have higher risk, right? You will have higher volatility. And then in terms of market pricing, the two different accounting regimes differ at their ability of resolving investors' uncertainty, right? So ultimately, if investors have more uncertainty about the company's performance, then they will ask for higher price discount. And then the two accounting regimes are different at how good they are helping investors to learn about the firm's true performance. And so we did some calculation and derivation, and what we find is that a sufficient condition for the manager to invest less in financial assets is that to invest less under the inclusive regime is that this following equation holds. And this following equation, like if I speak intuitively, that is the case when the investment gains and losses has really low persistence, low rho 2, and when it has really low measurement noise, that is low sigma 2. So in other words, what we see is if the financial investment gains and losses can be measured accurately and is not persistent, then it is problematic because it's going to really drive down the firm's ex-ante investment into such financial assets, making it further away from their first best. And the reason is, well, we probably all understand why higher rho 2 is, why lower persistence is bad, because that stream of income is less relevant. So including them makes less sense. And then here, the higher sigma 2, why it can be problematic, that's because, well, if it is measured very accurately, and then it actually can make this net income number more about this investment gains and losses, right? It measures this particular period very accurately, but it diminishes, it introduces too much unrelated measurement noise when we try to understand its core operating income. So in other words, it sort of distorts the information content of net income for understanding operating income purpose. Okay, so we think this is kind of interesting because if we think about fair value gains and losses, the problem is that, yes, we have really accurate measures. We can quote market price. And that's the problem is that they probably are quite low persistence, right? So we think if we believe this is satisfied, if this is the case, and if there are sufficient amount of inattentive investors, then we would predict that firms would invest less in financial assets. Okay. Yes, Barrett.
I'm just trying to just trying to think about this. So when X2 is not persistent but is measured more accurately, so I think we can certainly agree that, like, particularly for equity securities, right, we can measure the gain or loss accurately. But in terms of the persistence, I guess I'm trying to think of this from a back to this idea of a market efficiency perspective. Are the prices more persistent when the market is less efficient or less persistent? I'm trying to go back to PED, right? PED and some of these others show that the market's not efficient because the returns are more persistent, right?
Mhm,
So
right.
so anyway, how does that play into this? And so
Yeah, so
is it gonna help or hurt to have a more efficient market in this sense?
So I think if we say helps or hurts, we have to talk about some particular welfare function. Like here, we're just talking about whether it's gonna lead to more or less investment.
So yeah,
higher or lower
never mind.
price discount.
Forget the help or hurt. Just say, is that going to lead to more or less investment in financial assets? How does the efficiency affect that?
Yeah. So here, higher persistence will lead to higher investment. So yeah. So here's the problem is you have operating income, which we assume to be much more persistent than the investment income, and then the less persistent it is, the more heterogeneous the two streams of earnings are, and then mixing them will be more problematic for investors who cannot really tell their differences apart. Okay, so I just want to move on to empirical results. We think that our paper will complement with Barrett's paper and as a concurrent papers to give us a more holistic picture about the impact here. So we again we also look at insurers, but we didn't really look at their detailed portfolio holding. Instead, we actually maybe spend more time studying the market reaction to accounting numbers before and after this accounting rule change. Okay, and also we focus more on the channel. We try to look at how the amount of analyst coverage will mediate this impact. So the idea being that more analysts will help investors understand the numbers and then really sort of minimize the portion of inattentive investors. And also we differ in terms of a sample period. Our sample period is from 2015 to 2020. We have 3 years before, 3 years after, so that we want to have a longer horizon. Okay. So I first want to show you the earnings, reported GAAP earnings become way more volatile after this rule change. That's understandable, right? That's many commentators' complaints. Okay, and also if we take out this UGL, the unrealized gains and losses part from net income, we see that the volatility didn't really change much. So that's kind of saying, yes, this accounting rule does increase firm level net income volatility quite a lot. Okay, and another thing is it's going to reduce. So here is the earnings persistence we obtain from one regression of net income on previous net income, and what we see is persistence drop quite a lot. But if you exclude UGL, it doesn't drop as much. Okay, and then here, analysts' view on investment gains and losses. This is what we get from discussions. We talked with several analysts covering the insurance industry, and almost all of them said that while this stream of earnings is much less relevant, and it's very transitory, and they don't really forecast this. So analysts just put zero there. Okay, when they do the pro forma income statement, income unrealized gains and losses, they put zero there. We get several of their templates. And here we want to say a little bit about investors' reaction. So one thing is we actually form 3 portfolios based on the amount of unrealized gains and losses. So we have three of them. So we have bottom and the middle and then top tercile. And then what we see is before this rule change, right? The market, so here zero is announcement day. So basically market does not really respond much to the equity UGL. But if we look at the post period, what we saw is, okay, so the green line is the top tercile of UGL, and then the blue line is the bottom tercile, and we see market like just dramatically, it's quite, you know, obvious that they start to respond to this. Yes, Annika?
Yeah, I just want to remind that we have 5 minutes left. Thank you.
Yeah, okay, thank you so much. Okay, so we do a little bit of market reaction test, or what we put in here is just we put the cumulative abnormal returns, and then we put in earnings surprise, and then we put in equity UGL. UGL stands for unrealized gains and losses. So that was just too much of a mouthful. And we also put in fixed income UGL. So the idea is that this rule change doesn't affect fixed income UGL at all. So if this is something else affecting our results, then this probably will affect the change in fixed income UGL, how market reacts to this as well, right? So we control for like the we put in standard controls. So here's the result. We have short term, a medium term, and a long term. And then if we look at CAPM CAR, like what we see is, well, first, if we look at this equity UGL in the post period, the market responds to it much more strongly. But if we look at fixed income UGL, it doesn't change much. So I think that gives us more confidence that, you know, it's the accounting rule change, but not changes from the firm's investment strategy or whatsoever. And then what we also show is that, well, the impact is much more pronounced among firms with lower than average analyst coverage. Okay, so that's the sample of public firms only. And what we see is like here's the triple interaction term actually is negative for the high coverage firms, meaning that the increase in response to equity UGL is diminished for those for the firms, for investors have with the help from analysts. Yes, and then I have 2 minutes and I want to talk about the ex-ante investment results. So here, I think our research design is different in that first we have like longer time horizon. We have 3 year after and post. And then also, I think our post year 2020 includes the COVID year, which has a lot of market volatility. And I think that year truly highlights the problem brought in by this unrealized gains and losses, right? And so we believe that year is also like a valid data point. So we just put them together. What we find is that, well, here we put in public firms and we use private insurers as control group. So as Barrett has explained, like they follow the same statutory accounting. So like the holdings from their statutory report will be used here. And we use a diff design. What we find is relative to private insurers, public insurers reduced their equity securities after this rule change. Okay, and actually, if we look deeper into the data, we are like currently revising this paper. We don't have time to actually have a newer version, but we think that actually the result is way more like sort of, you know, significant in the year 2020. So I think that might also be a reason why we sort of get different results. So yeah, so overall, we also find that if we use propensity score matching, like the results like stays. So we think like our results collectively suggests that first, there are investors who are like kind of inattentive, and the market direction to unrealized gains and losses differ a lot under the inclusive regime. And then this can actually have an impact on the firm's investment decisions, how much to really invest in those marketable securities. And I want to thank you all for all your excellent comments. I will definitely think more about that. Thank you.
Yeah. And thank you everyone for coming. Thank you, Annika. Yeah.
Thank you.